Hello, good afternoon, everybody. My name is Richard Barfield. I'm the Chief Financial Officer at Ergomed. And I'd like to just start by saying how much I welcome this opportunity to talk to individual and private investors, retail investors, and to provide you with the same access, the same detail, the same narrative as we do with our institutions. The presentation this afternoon will primarily be focused on the 2020 results, but just a couple of days ago we issued our trading update, giving a snapshot of the performance of the company over the first half of 2021. And when we come to the end of the presentation, I'll provide some detail from that. If we go on to the next slide, please. Next slide. Thank you. So we'll start off with a statement of our vision. We are aiming for global specialized leadership in orphan drug development, oncology, and patient safety. That's been our vision for a few years now. We're staying true to that vision. And for those of you who are not familiar with the company, because I recognize that there are both existing and potential new investors on the call, we work with companies to run clinical trials of new medicines and to monitor the safety of drugs once they are on the market, and that's what we do. Going on to the next slide. We've been around for 23 plus years. We've been listed on the London Stock Exchange for about the past 6 years. And during that time, the company has grown hugely. A lot of that has been due to organic growth. We've grown at a compound annual rate, as you'll see later, in revenue terms of over 20% per annum for the past few years. But we've also undertaken a number of acquisitions. Most recently in 2020, we acquired Ashfield Pharmacovigilance, and a pharmacovigilance company, and we acquired Medsource, a CRO company. I'll be saying much more about those as we go through the presentation. So strong growth over the past few years, driven both organically and through acquisition. We go on to the next slide. The focus on this slide is really on two things. First of all, scale. Our scale is quite significant on a global basis. This is a bit of a well-kept secret, if you like, but we do have global coverage. We have around 1,200 employees now globally, about 1,500 if you include contractors. We're present in 60 countries where we're conducting clinical trials. We are supporting products through pharmacovigilance in over 100 countries. We have 16 offices worldwide. And the other key theme here is one of growth. As I mentioned earlier, we've been growing at over 20% per annum over the last 6 years since the IPO. We're growing particularly strongly in the USA with 82% revenue growth in 2020. And in 2020, our growth continued in that 20% plus vein with a 26.5% overall growth in the revenue. On the next slide, we're giving an update of the markets that Ergomed targets, and I think this is really important from a perspective of how Ergomed has been able to respond to the COVID-19 pandemic. The global CRO market is over $42 billion globally, and within that, oncology is a very big part of that, growing at 9.2% per annum. Rare disease is growing at 10.8% per annum. An important point about both oncology and rare disease is that these are two of the areas which have been the very least affected because they involve research into critical unmet medical needs, have been the least affected in terms of cancellations and delays to clinical trials of any therapeutic areas within the market generally. Pharmacovigilance is a fast growing part of the market, growing at 15.8% per annum for the next few years. That's really being driven by increasing complexity of pharmacovigilance requirements, as well as more and more countries globally coming into line with PV standards around the world. I mentioned earlier our two acquisitions in the USA. This is a very, very important focus for us because, as I'm sure everybody will be aware, the US is the largest, the most dynamic, the most well-funded pharmaceutical research market in the world. On the next slide, we focus on the market opportunity that we perceive. Sorry, I think we skipped a slide. Thank you. The market opportunity that we perceive for Ergomed. There's a lot of detail on this slide, but I'm just going to focus on what we describe as the mid-tier of the market. This is typically defined as companies that are in the $100 million plus revenue range, anything up to $1 billion in revenue. Typically global companies, 1,000 plus employees, double-digit growth, and so on. And you'll see from the data that I mentioned on the previous slide that Ergomed sits squarely in the center of this mid-tier market. We are increasingly competitive against our mid-tier competitors. We're also penetrating into the large tier sector with some of our specialist services, particularly in biotech and specialty pharma companies, where we are focused on orphan drugs, rare disease, and oncology. But the other very important trend that's happening in this mid-tier market is one of consolidation. And you'll see on the right-hand side here, Chiltern, where I used to work, Synteract, another mid-tier company, Clinipace, have all been taken over in the past few years. Synteract and Clinipace actually quite recently. We know that there is further consolidation in the pipeline. And what that means for us is that this market is opening up. There are fewer players. There is a bigger piece of the pie for us to go for. But it also means that we can position ourselves as a consolidator. And you've seen, as I mentioned previously, that M&A is a really key part of our strategy. And we're very focused on looking for opportunities to invest and grow our business on an inorganic basis. The next slide talks about the first of our two divisions. This is our clinical research services business. And what we do here is, on behalf of our clients, we help them to conduct clinical trials for new drugs which are in development. And you'll see from the two charts on this slide, I won't go into a lot of detail on the numbers. It gives you a scale of the business, about 31.3 million revenues last year, growing revenues year on year, as you can see, since the IPO. And a very important factor in this business is the order book. And I will just dwell on this for a second, because the order book isn't orders which are in the pipeline, which we have won, but which can be cancelled. Orders for us are clinical trials which are in progress. So we've won the award, it's fully contracted, the future revenue stream is fully committed. We've started to recruit the investigators, recruit the patients, conduct the clinical trials, and we know with a high degree of certainty that this book of revenue will roll out in the future years as we conduct the processes that are required for each of these clinical trials. And so what this tells you is that we have a very high degree of predictability, of visibility of our future revenue stream in this part of the business. As you can see at the bottom of the page, our underlying CRO revenue growth has been growing at over 18% CAGR over the past 5 years. And you'll see that that revenue growth has actually picked up again, and if anything, accelerated as we've come into 2021. The next slide focuses on our therapeutic area focus. I spoke earlier about oncology and rare as our key focus areas. And the important point about those is, as I mentioned, that these are two of the areas which have been least affected by the COVID-19 pandemic, which has really helped us with the resilience and the momentum in our business. And combining those two, for last year, so 2019, well, the previous year, 2019, the combination of those two was 66%. If you look at the same figures for this year, for 2020, you can see that the combination of oncology and rare is 88%. So our therapeutic area expertise and focus is increasing all the time. If we then turn to the most recent acquisition that we've made in this business, this really underpins the focus of our strategy on developing our business in the USA. And just as a broad comment, 2 years ago within the US, we had about 30 people. We've now got around 230 people. Our revenue growth in 2020 in the USA was 82%. So in this core market for both pharmacovigilance and CRO, we are growing very rapidly. In December, we acquired this company, Medsource, a company headquartered in Houston, Texas, with operations in Boston, Raleigh, North Carolina, and a presence across the whole of the USA in terms of business development, project management, and presence on a statewide basis. We paid $18 million initially for the business, about 10 times EBITDA, which we think is a very competitive pricing structure. It's a very specialized company with over 200 oncology trials over the past 20 years. They're also focused in rare disease. And they've really given us a very strong foothold to develop and accelerate our CRO business in North America. 20 plus new clients, currently around 40 studies running, and that business integration is going on very well and making good progress as we go into 2021. We now turn to the other division within our business, which is called Prime Vigilance. This is our pharmacovigilance solutions business. And what happens in this business is the monitoring of adverse drug reactions, so the detection, the assessment, the understanding and prevention of adverse effects, other drug-related problems, once products have been licensed and they are on the market. And our clients in this business want to make sure that we are providing this service to the very highest standard, that we are complying with all the regulatory requirements, and as long as we're doing that, they will continue to renew their business with us. And our typical renewal basis for contracts in this business, after an initial typical 3-year contract duration, the renewal rate is about 95%. And you'll see in the chart on the right that annually each cohort of clients tends to increase the amount of business that they do with us, and that just grows from year to year to year. So we keep winning new clients every year, and then we keep building on the clients that we've won from year to year. And then in 2020, we've obviously got the additional benefit of another acquisition, Ashfield Pharmacovigilance, which I'll speak about in a moment. So it's a very sticky business. And the chart on the left-hand side shows you, in a way that's very similar to the chart that we saw for CRO, that the order book just continues to grow and grow and grow, and it gives us a very high degree of predictability of the business looking forward. On the next chart, we're talking about why this business has been so resilient through the COVID-19 crisis. We implemented our business continuity plan very successfully. We transferred all 700 staff in Prime Vigilance to remote working. We actually found that our productivity increased. The number of adverse cases or case volumes increased during this period. And we also won some significant new COVID-19 contracts to monitor drugs related to COVID-19 therapies. So it's been a very resilient business, as has the CRO business throughout the pandemic. And I mentioned earlier that we had made an acquisition in this business. This was in January 2020. The target company was called Ashfield Pharmacovigilance. On the right-hand side, you can see that we paid $10 million for a business making $900,000 EBITDA, so we paid about 11 times. And for that $10 million, we gained 40 new clients. We gained an order book with contracted future revenues of just under $10 million, so a contracted future cash flow of nearly 10 million for a 10 million consideration. The business was making about $11 million revenue. We quickly moved to integrate operationally. There was a lot of synergies from the management integration. But one really key factor with this acquisition, which I'll say a little bit more about on the next slide, is to do with cross-selling, because having a presence in the USA with this business, around 80 people came with this business, and we're delighted to have them join the company as really experienced and expert new colleagues. We were able to go to our clients and say, we can now provide coverage for you for these pharmacovigilance services, not just in Europe, but across the whole of the USA, the largest and most important pharmaceutical research market in the world. And we could go to the newly acquired client base and say, we are Ergomed, we're Prime Vigilance, and we can now provide services across the whole of the world for you. So the revenue accretion opportunity here, as you'll see from the figures at the bottom of the page, has proved to be very significant. Going on to the next slide. One of the things that we've worked very hard to drive, and I think with a high degree of success, is cross-selling between our CRO and Prime Vigilance businesses, because essentially the clients that we're talking to are engaged in the same type of activity, the development, the licensing, and then the marketing of new drugs. And so by having our business development team in the position that they can go and talk about the full range of our products and services to all of our clients, you can see that we've generated a significant amount of new business. And to put it into perspective, the 8.6 million that we contracted in 2020 on an $86 million revenue is 10%. So that has given us effectively a 10% uplift in our revenue. And you can see from the pipeline figure that we're generating a lot of interest across both sets of clients in the services that the other division is able to provide. And so we're continuing to work on this. We're continuing to see strong revenue accretion and significant opportunities emerge from this cross-selling activity. I'm now going to move into some discussion of the financial headlines for 2020. This is going to seem like rather old news, and I'll say a little bit more about H1 2021 in a moment. So I'll quickly run through 2020. But I think you'll see that we've had a financial performance in 2020, which is worth spending some time. Our service fee revenue was up 32%. As I mentioned earlier, we grew in North America by 82%. Our adjusted EBITDA went up at more than double the rate of our headline revenue at 55%, and our employee numbers went up 35%. You can see the little chart on the right-hand side showing why those employee numbers went up. Obviously, some of it is through the acquisitions of Ashfield and Medsource, but some of it is also organic. And I will just say that through the whole period, and with particular emphasis on Q2 2020, when the pandemic first hit, we continued to hire. We had no furloughs, no redundancies, no layoffs, no hiring freeze, and our activity really maintained its momentum and showed great resilience through that very difficult period. On the next page, we talk about the highlights for 2020, and in our announcement, we described the performance as excellent. I think that was a very reasonable statement, as you'll see from the numbers in a moment. The strategic transition continued at pace. We said a couple of years ago that we would transition to a services business model. I'll say a little bit more about that in a second. The response to COVID-19 was very resilient. The acquisitions were conducted and integrated very effectively and rapidly. And we came into 2021 with a very robust financial base and a very solid position in terms of the visibility and the predictability of our future revenue stream. And I'll bring out some of these themes as we go through the numbers. There's a lot of detail on this slide. It's a snapshot of the overall financial performance for 2020. Just a few high-level comments. The revenue went up 26.5%. The gross profit went up 35%, and the adjusted EBITDA went up 55%. So why did the adjusted EBITDA go up so much more quickly than the revenue? I think there are a number of very good reasons for this. The first one is to do with the strategic transition to a services-based business model. The second one is to do with the mix. So the pharmacovigilance business is rather profitable. Through the Ashfield acquisition, that went up to 2/3, 64% actually, of our revenue stream. So that was pulling through a higher level of gross margin. We also benefit from operational gearing. So as the company continues to grow, our largely field-based project management teams and clinical monitors become more efficient. Their utilization productivity increases, and that comes through into an improvement in our overall margin and adjusted EBITDA. And then finally, you'll see that there is an underlying trend in both our CRO and PV businesses of improving gross margin. On the cash, just on the previous, thank you. On the cash flow, I think it's interesting that you've got the net cash of 19 million there. We actually generated about 19 million of cash over the year as a whole, once you include the or before you take out the cash flows needed for the acquisitions. What this is telling you is that our cash generation or our cash conversion from EBITDA is very high. And then you can see the order book, and this is the point I made on the previous slide. We're positioned very strongly as we come into 2021 with an order book up 55%, and that is delivering the revenue stream for the first half of the year and also for going into the second half and into future years. We did a capital reduction to strengthen our balance sheet as we came into 2020, and you can see that the consolidated retained earnings on the balance sheet went up by about 50 million pounds, and we also increased our basic adjusted earnings per share by 30%. So, as I said right at the beginning, overall an excellent financial performance and a very strong financial position. On the next slide, we focus on the transition to the services business model. A lot of detail on this slide, so I'll just confine myself to some high-level comments. The light blue that you can see at the bottom of each bar, that's the CRO business. And you can see that in that business, not only did the revenues go up, much more about that to come, but the revenues went up, and at the same time, the gross margin went up. So overall, in the context of the pandemic, a strong performance from the CRO business. On the pharmacovigilance side, a very strong underlying rate of organic growth of about 30%, including Prime Vigilance, the revenue went up by about 56%. And similarly, in the PV business overall, the gross margin went up from 52.2 to 52.4%. So overall, looking at revenue and gross margin, a strong performance. I did say that I would talk a little bit more about the CRO returning to growth, which we can see on the next slide. And when you look at the overall annual growth, only 4.4%. But if you break that down into some detail, if you look at the second half of 2020 over the first half, there was a return to growth of 13.5%. And then if you look at the second half of 2020 over the corresponding period in 2019, the growth was 16.7%. And that level of growth over the second half of 2020 has now continued. In the first half of this year, 2021, we are up 16.2% on a reported basis, and on a constant currency basis, we're up 24.5%. And that tells you that clinical trial activity has resumed, clinical monitoring in the field has picked up again. The very strong tailwind that we enjoy, which is a real driver of our business, of pharmaceutical research expenditure or investment globally, that has resumed and is continuing, and that's really helping to support the continuing growth or the resumed growth of our CRO business. Just to explain a little bit more about the strategic transition to full service revenue. So a few years ago, the company had a strategy of investing of being both a full service business, providing the CRO services to external third parties, but also co-investing in drug development projects. We said in 2018 that we were going to stop doing that. That's taken a couple of years to work its way out of the system. And you can see that 2020 was a year in which we just about finished off that activity. You can see co-development going down from a quarter of our business to less than 10% of our business, and correspondingly full margin third-party service activity went up from 75% to 90%. The importance of that is that you can see that the ongoing third-party service fee activity has continued its growth rate. I mentioned earlier a CAGR of 18%, 17% last year in spite of the pandemic. But also it's that higher margin piece of the business which is continuing to grow, and it went up from 18.4 million to 21.5 million last year. Now to move on to some information about our geographic spread, again underlining the importance of the USA for us and why strategically it is so important for us to focus in this area. You can see North America on this chart going up from 37% of our revenue in 2019 to 54% in 2020. And I mentioned earlier the strategic importance of this market in terms of being the largest pharmaceutical research market globally. So hence the very, very necessary and welcome growth of our business in the USA. The sales and order book that we managed to generate, we can move on, in 2020 is also extremely encouraging. Again, bearing in mind it's a pandemic year, in 2020 our overall sales new awards grew by nearly 42%. Our contracted order book, and again, risk of repeating myself, this is the committed, contracted, in process book of business that we are delivering to our clients, which is predictable and visible going forward, grew by 55%. Now, of course, that includes the impact of the acquisitions, but what this is telling you is that we are now a larger, stronger, more financially stable, more predictable business than we have been previously, thanks to the bulking up as a result of those acquisitions. And then finally on cash flow, just to reiterate the point that I made earlier, you can see in the left-hand chart the light blue bar with the 19 at the top of it. That's our operating cash flow in 2020, 19 million. Bearing in mind the EBITDA of 19.4 million, we have a 98% cash conversion from EBITDA to operating cash flow in 2020, which is a very strong performance. And the chart on the right-hand side, I think, is a rather nice one. It shows you, obviously, in January we acquired Ashfield Pharmacovigilance. That required some cash. Then you have a steadily building cash balance as we go through the year. More cash outlay on another acquisition in December. But finishing the year at 19 million, up from 14.3 million, in spite of 12 million pounds invested in new inorganic growth. I'll finish off by running through 3 slides very quickly on the trading update that we issued. So this is a snapshot of our trading over the first half of 2021. We issued this announcement on Tuesday morning. Typically we comment on revenues, order book, sales, cash. We don't go into any detail on EBITDA and margins and so on. But we did start by making the statement that we continue to be in line with full year market expectations. I'll say a little bit more about that in a second. Our chairman made the statement that we delivered exceptional results and operational progress in 2021. The transition to a services-based model I spoke about earlier, that's been completed. both PV and CRO saw substantial revenue increases over the first half of the year, and our sales performance and order book and financial platform were strong, and that puts us in a great position as we come into the second half of 2021. On the next page, there's a bit more detail. Just a reminder that about 6 weeks ago we had our AGM. We issued a statement saying that at that point we expected to be materially ahead of the then current market expectations for EBITDA. So the market expectations were uplifted at that time. On Tuesday, we said that we continue to trade in line with those uplifted market expectations. Overall, our revenue growth was 38.8%. And I will just, and this is an important point that comes through on all of this data, the pound has been strong relative to the US dollar over the first half of this year. That impacts our revenue in reported terms. And so just to put things into perspective, we're giving the constant currency comparison. So if you look at H1 2020 and H1 2021 on the same exchange rates, you get a revenue uplift of 48.1%. The CRO, with the benefit of the acquisition, was up 90.7%. If you take out the acquisition and look at the CRO growth on a like-for-like basis, it was up 16.1% or 24.5% in constant currency. Prime Vigilance was up 16.2% in constant currency, and our total service fees were up 37.2% in constant currency. The summary of all of that is we've had a very good growth performance over the first half of 2021. And then finally, moving on to some comments about the sales awards, up nearly 51% in the first half of the year. The order book up 18%, putting us in a very strong position looking forward to 2021 second half and beyond. We've continued to grow in the USA. We've also grown internationally. We recently opened an office in Tokyo. We've set ourselves up in some new countries in Europe where we didn't have a presence previously. And our cash balance has continued to grow and is now, or at the half year, was 24.6 million. So I will summarize by just on the next chart, talking about the highlights of the 2020 performance and the first half of 2021. So we've maintained our strategic focus in oncology and rare. Technology is a big focus for us. We are a technology leader in terms of the application of technology and to our business and making this available to our clients. We completed 2 strategic acquisitions in 2020 and finalized or concluded our strategic transition away from the co-development strategy. Our organic growth continued to be strong at 26.5% in 2020 and similarly strong over the first half of 2021. Very successful cross-selling results. And the business, I think in the overall context of COVID-19, I think the business performance has been good. And we have a very strong, stable, a much larger business than previously, very well positioned for future organic growth and strategic M&A. So that completes the presentation, and I'll now be very happy to take questions.
Thanks very much for a very interesting presentation, Richard. Can I just remind attendees that if they'd like to ask questions, click the Q&A button towards the bottom of the screen and you can type your question in. We have one question so far from private client broker Barrett & Cook. They're asking, have you seen any material tailwinds to CRO or pharmacovigilance in light of the COVID-19 pandemic, vaccine developments, etc.? If so, are these one-off in nature or longer lasting?
If I may make 2 very brief comments about this. Firstly, as we've all seen, the the speed at which the vaccines were developed and the clinical trials were conducted has been absolutely astonishing. And what has happened to enable that is that new ways of conducting clinical trials have been developed, ways of working in parallel in terms of the trial at the same time as the regulatory process is being underway, and also the use of technology for a number of things to be done virtually, such as patient consent, have also been introduced. So there is, as I mentioned earlier, a very strong tailwind in terms of the ongoing level of investment in pharmaceutical research and the funding that's going into things like biotechs, other types of funding such as central government funding or national health budget funding of development of drugs for rare diseases. So those long-run tailwinds around pharmaceutical research investment are still there, added to by these new techniques and technologies which will allow clinical trials to run even faster. So I think those tailwinds have been enhanced as a result of the success of the drug development around COVID-19. On the pharmacovigilance side, the importance of pharmacovigilance, I think, has really been underlined by the fact that new drugs and treatments and vaccines have been developed for COVID-19, and understanding the effects, potential adverse effects, the consequences of the administration of those drugs, and keeping track of all of the drug reactions is obviously really critical. So pharmacovigilance has become a very important topic, and there are added tailwinds, I think, for that as well, on top of what were already strong tailwinds around the adoption of higher and higher pharmacovigilance standards in places where PV was already happening, but also in many other countries around the world. So the simple answer to the question is yes, the tailwinds that were there before are still prevalent, and also there is new momentum and new factors as well, which we think will be beneficial for our business.
Thanks, Richard. Next question. In light of the strong cash flows that the business is generating, might you give any consideration to dividends for shareholders?
Yes, that's a very good question, and thank you for that question. I mentioned earlier that we've that we did a capital reduction. We issued a circular. We got our shareholders' approval for this during the course of 2020, and the effect of that was to boost our retained earnings and put us in the position that if and when the board decides to do so, we can actually pay a dividend. We were actually technically unable to do so previously, and organizing your balance sheet properly and tidying things up in that way is always a good thing to do, and it's a necessary prerequisite before you can start thinking about paying dividends. But I will just emphasize that process was not done in immediate contemplation of a dividend actually being paid. The board has not made the decision to do so. We may well consider it later this year or sometime next year, but I will say that it's not on the agenda at this time, and it's not something that we're planning to do. We think there are lots of opportunities for us to invest, both for organic growth. So I mentioned technology earlier, so we can invest in new technology. We can invest in new sales and marketing activity to increase the rate of our growth. So the increase in our cash is obviously very welcome, and the opportunity to invest is very welcome. At the same time, we have an active program of looking for M&A opportunities, not just in the USA, not just in CRO, in all parts of our business and on a global scale. And that is the focus right now, rather than thinking about paying dividends.
Thank you. Yes, I mean, as a potential prospective shareholder, I would say that whilst you're earning very good returns on capital, it makes sense to reinvest where you can do so productively. That's fine. The next question is a technical one. Are you giving any consideration to changing your reporting currency to US dollars, given the increasing focus of the business in that market?
I think the simple answer to that is no, not at this stage, or perhaps the right answer is not yet. We are a UK listed company. Our investors are primarily UK institutions, and for the moment we're comfortable with sterling as our reporting currency. Obviously, as the business continues to develop in the US, we'll look at additional opportunities there. There may come a point where our growth in the US outstrips the size of the business elsewhere in the world. There may come a point where it makes sense to look at US markets in terms of fundraising, but we're not at that point yet. There's still some way to go before we get there. So for the moment, the simple answer to the question is no.
Thank you. Next questions are from Freddie Ahad. Two questions. Firstly, on the CRO side, does the audit book contain multiple phases of a particular trial? And have we experienced any instances where clinical trials which got through early phases fell down at later stages and put the order book into reverse? Freddie's second question is on both the CRO and the pharmacovigilance side. How exposed are we to loss of a key client? So how concentrated is your client book?
Yeah, okay, good. Both excellent questions, thank you. Just on the first one, do we typically sign contracts for clinical trials to go through multiple phases? The answer to that is really no, because typically what tends to happen is that each phase of the trial is funded in its own right as a standalone activity. And until the results of each phase of the trial are known, it isn't really known whether it will actually move into the next phase. So, you know, a phase 2 trial could be with a relatively limited number of patients, so in the tens rather than the hundreds. And then a phase 3 trial would move into the hundreds and possibly thousands of patients. And so the scale of the contract, the project, just the numbers involved, not just patients, but also financially, are quite different from a phase 2 to a phase 3, just as examples. And really, until you know that you've reached that you've attained the end points at each specific phase in the process of the development of a new therapy, you're not really in a position to say that it will definitely move into the later phase. And also, sometimes when it goes into a later phase, then the developer of the drug, so the sponsor, may take a different tack in terms of bringing in an additional sponsor for the funding, or licensing it, and sharing some of that financial burden with another sponsor. So typically it tends to go from phase to phase, and the contracts follow that phase to phase process. In terms of clinical trials that fail at a later stage, I think I've probably just answered that. It goes from phase to phase. If it gets through the first phase and the results are good, if it goes through an early phase, then it'll go into a later phase, and that's just the way it works. In terms of the exposure to loss of a key client in both CRO and PV, we have somewhere around 250 clients across the business as a whole now. We have a very good spread of clients. We don't tend to be involved in the preferred provider type of situation where one major large pharmaceutical client will use one CRO for a large number of trials. That's not really the market that we operate in. So we're more focused in biotech and specialty pharma. So what that means is that typically no single client will be dominant. There won't be any single client where we'll have a very, very large number of trials. Perhaps the best way of illustrating that is to say that in neither the CRO business nor the pharmacovigilance business do we have a client that represents more than 5% of our revenue.
Thank you. Next, private investor Jay Shah is asking whether there are any new broker notes issued since your last update, and when are the next results due, please?
Yeah, so taking that in reverse order, the next results will be our interim results. So this will be a more detailed statement of all of the facts around our financial performance, and commentary on our operational and strategic position for the first half of the year, which we typically do in about the third week of September. So that's again what we're planning to do this year. So the full set of interims will come out late September. And sorry, what was the other part of the question?
Have there been any new broker notes?
Oh yes, the broker notes. Yes, there have been broker notes since the trading update was issued on Tuesday morning. So we have two brokers, joint brokers. One is Peel Hunt, and the other one is Numis. The analysts at both Peel Hunt and Numis have issued notes with updates and commentary on our performance over the first half of the year. And if you know anybody at Numis or Peel Hunt, they should be able to obtain those for you if you are a client with them. We're not, I'm afraid, allowed to issue or distribute those broker notes. Neither of the brokers at this point have changed their outlook for the year as a whole. They will look at our more detailed statement that I just spoke about when we issue it in late September, and they will form a judgment on that and decide whether they want to change their outlook for the year as a whole on the back of that more detailed set of figures that we will publish then.
Thank you. Next, from Bruce Fair. Can you talk a little about the size of acquisitions going forward? So are you likely to be looking at larger acquisitions? And how is the competition for the sort of businesses you're looking to acquire looking like, and the valuation of deals? Are they getting more expensive to do?
Well, I'm going to start perhaps by using a couple of words which are potentially contradictory. The first one is that, you know, in the world of M&A, you have to be opportunistic. I mean, you never know what's going to come across your desk. I think we are quite well known as a company that's looking out for acquisitions. We have an investment bank working for us, proactively going out and looking for opportunities. And so, you know, when they come along, you have to take your time, look at them, and decide whether it's a good fit and whether it's likely to be a price that you're prepared to pay. But at the same time, you have to be disciplined, and we believe that we've shown in the two acquisitions we've done in the past year or so that's exactly what we've done. We've bought at sensible prices. And we've also been very effective and rapid in the way that we've integrated those businesses and generated revenue and profit accretion from those acquisitions. And being disciplined also means that you need to know when to turn something down and when to walk away. So those are our watchwords, if you like, as we think about acquisitions. In terms of the scale of what we're looking for. Typically, we would be looking for something that's going to bring some size, going to bring some significant client client base accretion for us. It has to be strategic, so it has to be in the right markets. That's not just in the USA. We're also looking at Asia, we're looking at Europe, and it could be in either the CRO or the pharmacovigilance areas. We're probably not going to be looking at something that's in pharmaceutical services more broadly. We need to remain focused. Pharmacovigilance, oncology, rare disease are our core strategic focus areas, and we will remain true to those. In terms of price and competition, this industry, these companies are typically quite attractive for a number of different buyers, whether you're private equity, whether you're a large strategic. The opportunity to buy a business that has, such strong underlying financial characteristics. So typically growth, decent margin, strong cash flow, high degree of predictability of revenue streams. These are attractive businesses. So yes, there certainly is competition. So don't expect an acquisition from us, every other month. It takes time to find the right ones and to work through the opportunities and to beat off the competition. Pricing can get quite competitive, but as I mentioned earlier, we intend to remain competitive. We're not going to overpay. It has to be the right fit, and it has to provide a real revenue and EBITDA accretion opportunity for us.
Very good. That all sounds sensible. Next question is from Damien Cannon. Can you provide some color on the growth constraints that you face? Is it the difficulty of winning business from competitors, or are you constrained by the overall growth rate of the market that you're operating in?
Yes, okay, thank you. Another really excellent question. I think there are two or three factors here. The growth rate of the market is a factor, but we are operating in markets, as I showed on the slide earlier, which have got strong underlying levels of growth. The CRO industry generally somewhere around 7%, and then in both pharmacovigilance and CRO, in oncology and rare disease, the markets driven by the level of funding going into pharmaceutical research and the number of new products that are being launched on the market all the time. Those specific markets that we focus in are growing strongly. So we regard that as a tailwind rather than a constraint, if I can put it that way. One of the constraints is talent. Finding, retaining good people, recruiting enough people to support the growth of our business is a factor. We think we're very good at that. We have very active recruitment programs and onboarding programs and so on. So we think we're dealing with that pretty well. And then yes, winning business against competitors is always challenging. But again, we think if you look at some of our ratios, such as our book-to-bill ratio, our win rate ratio, and so on, we think we're punching at our weight, if not above our weight. So we're feeling quite optimistic about the continued growth potential of the business.
Thank you. Next is from Alan Carter, which is kind of a related question. I think that the first part is really asking about the growth potential in the UK versus overseas markets. And how big is the potential? Is there any limit to the potential growth, or can you see a long runway ahead?
Well, we can see a long runway ahead. I mean, I wouldn't say that the growth potential is unlimited. I think that would be a rather bold claim.
Yeah.
But we have consistently grown at over 20% per annum since the IPO. Last year, our growth was 26.5%. I spoke earlier in the presentation about the growth that we've seen in the first half of this year. Bearing in mind that certainly over the past 18 months, all of this is happening during the course of a global pandemic, we would say that the growth opportunity is still there, and as we start to come out of this, if anything, it should be enhanced. In terms of UK versus overseas, I have to say we don't really think about it that way. This is a global industry. We are a global business. Pharmaceutical research is going on all around the world, and if you think of the great centres of pharmaceutical research in the world, you think about North America, certain parts of Europe, Germany, Switzerland, UK, Netherlands. Think about Asia, Japan, China. I mean, this is a global business. Growth is universal. Investment is universal across all of the major economies of the world, and we have to have a global vision, and that's what we're trying to do. We've spoken about our ambitions in the USA, which we've already started to realize. We've recently opened an office in Tokyo. We have a number of partners that we work with in Asia. We're very strong with a huge 25-year legacy of doing business in Europe. So we don't really think about it, as I said, in UK versus overseas terms. We're a global business.
Thank you. And then finally, another question from Bruce Fair, which is quite an interesting one. To what extent has Ergomed built a competitive advantage through the use of RPA and machine learning?
Well, we spoke about these things in our annual report this year, and in the preliminary announcement, and there's certainly more material in those documents and in the presentations which were given at that time, copies of which are on our website. So you can always go to our website and learn more about what we're doing to invest in these areas. I didn't include the slides actually in this presentation because it's quite a lot of detail and it's rather technical, but it's certainly there and it's available on our website. And yes, we do believe we are in the process of developing and delivering competitive advantage in this area, and it's one that we will continue to invest in. So when I spoke earlier about the cash generation and the ability to invest and looking at both internal organic opportunities as well as external M&A for our investment program going forward, this is precisely what I had in mind.
Very good. Well, thanks very much for that, Richard. That completes all the questions. Very interesting presentation and comprehensive answers. So once again, thank you. It's much appreciated.
Well, thank you, Mark. And can I just also say that, as I said right at the beginning, it's a real pleasure and a very welcome opportunity to talk to individual and private and retail investors, and to give them the same access, the same detail, and the same narrative as we do with our institution. So I'd like to thank everybody who's dialed in today and taken the opportunity to listen in and learn more about Ergomed.